Distinguished guests, ladies and gentlemen, good afternoon. It's my great pleasure to be addressing this prestigious audience at the 4th AMRO Forum. In fact, it is my first time attendance at the AMRO Forum, and I owe my invitation to He. Otherwise, I normally would not be here, and the reason why I'm particularly excited, I just met quite a number of old friends from my former life at the HKMA, and Chatuvan, and Diwa, and of course, He and Kelvin. So I am really glad that I have this opportunity to speak to all of you. The financial landscape we navigate today has changed drastically since the global financial crisis some 17 years ago. Structural shifts have accelerated over the past decade, particularly in the last 5 years. These pivots are catalyzed by a confluence of mega events forces, from technological innovation and regulatory evolution to macroeconomic upheaval and geopolitical realignment. The more interconnected markets and complex dynamics are reshaping the way capital flows, risks are managed, and resilience is built. The line between public and private markets has become blurred. So will the line between fiat currencies and stablecoins going forward. Navigating this uncharted landscape demands agility and foresight from regulators, deeper collaboration, and forward-looking strategies. These are the qualities that AMRO embodies, and they are also essential for us to regulate for progress in a world of pivots and perils. Now let me focus on some of these transformative forces in financial markets. The first is the rapid growth of the private credit market. Since the global financial crisis, the progressive phasing in of Basel III has increased capital and liquidity requirements for banks. This constrains the banking sector from extending excessive leverage to the real sector to shield the financial system from another shock. This has resulted in the rise of private credit, which comes in to fill the funding gap left by banks constrained by prudential regulation. Private credit increasingly acts as the mainstream alternative to bank lending to support growth and innovation. As a result, assets under management of global private capital have roughly tripled to $14 trillion over the last decade. As leverage provision shifts from banks to non-banks, the risk also spreads across asset owners and non-bank intermediaries. The two sectors are increasingly interwoven as banks provide margin funding to private fund managers and the underlying assets. For a sector of such fast growth, we have seen bifurcation in its asset quality. Recent collapses of First Brands and Tricolor in the US have sounded the alarm bell about the risks of private credit. They can be complex, illiquid, opaque, difficult to value, and susceptible to fraud. Retail participation in private credit is rising too, adding urgency for regulators to closely examine the private credit ecosystem and its key interlinkages with banks, insurers, and other key market participants. Investors and counterparties also need greater clarity and transparency on valuations, leverage, and governance structure in order to manage their exposure. To rise to the challenge, we have stepped up our surveillance of the OTC derivatives market in Hong Kong. Under the new requirements effective in September, it is now mandatory to report delta positions of OTC trades to our trade repository, among other data requests. In international forums, regulators are discussing how to standardize disclosure requirements to better manage counterparty risks. Any required disclosure should be proportionate, taking into account the heterogeneity of non-bank financial institutions and concerns about disclosing proprietary and commercially sensitive information. In this light, the industry is well placed to identify the key risks and information needed, and public-private partnership would be helpful to work out the details of necessary disclosure. The second driver of financial market transformation is technological advances in the past decade. Algo trading and machine learning have increased trading efficiency through lower transaction costs and faster execution. AI models enable robo-advisors to deliver automated, tailored investment advice to clients. Asset managers can leverage these models to identify investment signals from a survey of data today. Firms can also improve fraud detection and risk management. Further to this, Gen AI large language model hold even greater promises to boost productivity, save costs, and fuel innovation across the economy. So far, financial firms are using Gen AI mainly to improve operational efficiency, while use cases in trade execution are still nascent. They are also exploring agentic AI to further streamline workflows and minimize human intervention. Moreover, quantum computing is set to empower firms to perform complex real-time calculations. However, as we all know, technology is a two-edged sword. With a surge of computing power, financial stability can be unsettled by new operational risks, data breaches, and cybersecurity issues. AI models can generate inaccurate or biased output, leading to flawed trading signals, unsuitable investment advice, or mispriced risks. These models and their output can be more difficult to audit, validate, and explain. Furthermore, Gen AI models are known to hallucinate. Concentration of AI providers raises concerns on firms' operational resilience and potential correlated market behavior. On top of these, quantum computers may render current encryption technologies obsolete, therefore giving rise to data protection issues. In light of these challenges, we have emphasized to licensed firms that they must have a robust governance and risk management framework and fully understand the AI models they deploy. In particular, for high-risk Gen AI use cases, require firms to have a human in the loop. In addition, to adapt our regimes to changing times, regulators in Hong Kong are developing relevant cybersecurity framework and quantum-safe infrastructure. Now, digitalization and data standardization have improved the post-trade efficiency and driven trade settlement to migrate from T+2 to T+1 in traditional finance. The emergence of distributed ledger technology and digital assets, along with it, is the third driver of market transformation. They are putting instant clearing and settlement within our reach. As we all know, our younger generation lives their lives on mobile phones. The investment behaviors of these digital citizens is very different from the previous generations, which may also explain why digital assets are fast adopted. They are risk-tolerant, prioritize speed, accessibility, and peer-driven information on social media. They also embrace Web3 and 24 trading. This trend is particularly dominant in ASEAN countries, where the median age is about 30. Therefore, Hong Kong is leading the regulatory efforts undertaken globally to build a secure and trusted platform for digital assets. To future-proof our financial markets, a comprehensive regulatory framework for digital assets is in the making. We have in place the regimes for centralized exchanges, advisors, asset managers, and products. After public consultation, we are now finalizing the regulatory regimes for digital asset dealers and custodians. These will be the last pieces of our regulatory puzzle to support a robust digital asset ecosystem. In the meantime, we are seeing increased adoption of tokenized financial products in Hong Kong, such as tokenized green bonds and the SFC-authorized money market funds and retail gold products. With varying degrees of tokenization, these tokenized products in Hong Kong had a market size of around US $3 billion. At this stage, most of the tokenization pilots remain nascent, with considerable room for upgrades. Some have achieved modest efficiency gains and cost savings in clearing and settlement, while many continue to rely on the fiat currency to settle the cash leak. Many in the market now hold the long-term vision to put on-chain the entire life cycle of traditional financial products and achieve instantaneous settlement and its finality. The processes should cover subscription, redemption, trading, settlement, and record keeping. Under the guidance of the SFC and the HKMA, firms are now conducting live transactions during the pilot phases of Project Ensemble, where investors transfer tokenized deposits across banks to subscribe for tokenized products. To achieve scale, interoperability is essential. That would require a common blockchain layer to be built for interbank payment and its gradual integration with the broader financial market. In the Web3 ecosystem, stablecoins are used by crypto natives as a currency for exchange. If left unregulated, their widespread use would introduce new risk, particularly in case of large-scale redemptions. With Hong Kong stablecoin legislation coming into effect this August, the HKMA has put guardrails in place to ensure reserve assets backing the authorized stablecoins are properly managed and regularly audited by an independent auditor. None of us has the crystal ball to predict the scale and speed of tokenization or the use of stablecoins for cross-border supply chain payments. However, as Hong Kong continues the digital asset journey, we will be steadfast in upholding investor protection, resilient financial infrastructure, and sound regulation mirroring that in traditional finance. The last driving force is geoeconomics and new pivots in financial linkages. Geoeconomic strategies and tariff resurgence are reshaping global supply chains, fragmenting what was once a seamless global network into regional clusters. In Asia-Pacific, we have witnessed a decisive pivot towards regionalization. Intra-regional trades now accounts for nearly 60% of the region's total exports. Firms are fast adapting their strategies and diversifying production hubs to ASEAN economies. Capitalizing on these opportunities, ASEAN has transformed into a vibrant economic bloc. This realignment is mirrored in investment flows. Despite global headwinds, developing Asia attracted more than $600 billion in foreign direct investment in 2024, representing 40% of global inflows. ASEAN alone drew a lion's share. For Hong Kong to remain a critical financial conduit, financial firms here have forged new ties to the reconfigured regional treasuries, supply chain financing, and capital markets. The Middle East and other regional markets are also looking to Hong Kong for diversification and new financial linkages. This can be seen in the Hong Kong listing of an ETF for Saudi stocks and its subsequent cross-listings on mainland exchanges. And since the trade tension escalated in early April, the SFC has signed 6 MOUs with counterparts in Canada, Europe, and the Middle East, equivalent to the number of MOUs signed in the last 5 years combined. Within Asia, fragmented liquidity and diverging regulatory approaches pose challenges to a more integrated capital market. This will require regulatory collaboration among us in this region, and AMRO is best positioned to deepen our dialogue to build a more resilient and synergistic Asian market. So, ladies and gentlemen, the 4 drivers I mentioned are reshaping financial markets in magnitude unforeseen. Technology, shifting capital flows, and new risk dynamics are redefining the contours of our financial ecosystem. To avoid perils in navigating this transformation, we must pivot to action and collaboration. The imperative for regulators to adopt has never been greater. At the SFC, we strive to be the change that we wish to see in financial markets. We are reviewing our regulatory regimes to move with the times, balancing innovation with stability and growth with prudence. Rules must evolve to safeguard resilience while pushing for progress. We encourage market participants to embrace collaboration, transparency, and future readiness. We must also continue to leverage on regional institutions like AMRO in fostering dialogue and harmonizing differences across jurisdictions. When I mentioned Chadavan and Diwa, these are the friends that we made when we were pooling official reserves back in the 2000s, you remember, to form the ABFs and the PIF. And Bob, you were there actually, at the BIS. So at that time, it was in response to the Asian global crisis. We believe in recycling savings into investments. Now, 30 years on, we actually have moved, all of our capital markets have actually grown substantially. So I think this is time, given all these headwinds that we are facing, that we should have worked towards a more integrated capital market. So together we can turn this disruption into opportunity, division into trust, and global challenges into Asian prosperity. So thank you very much.